Adjustments for amortization. In the past lessons, after the adjustments for stocks, also called inventories, we reached the following trial balance, and also the following preliminary income statement. As I said, the top part is correct, but we are still missing some charges in there. The main charges missing are related to the fixed assets that we acquired during the year, because it's the first year. The van that we acquired for 3,100 euros and the machinery that we acquired for 5,000 euros. They are not consumptions of the year, but they do lose value year after year. Let's concentrate on the van first. Suppose it wears out and becomes useless and therefore worthless in 5 years. Then every year it loses, say, 1/5 of its original value, which was 3,100 euros. It will be treated each of the 5 years as a transaction. Here's the firm. The asset, the van, loses 620 euros and the firm consumes 620 euros worth of the van. I did not represent the rest of the world because it's not exactly a transaction with the rest of the world. It is not, properly speaking, an exchange with the rest of the world, but it has exactly the same pattern. Let's stress that. Indeed, suppose that instead of owning the van, we would rent it every year. In that case, it would be an exchange with the rest of the world every year. Every year we would pay money, cash or money from the bank, and we would get the right to use the van for the year. But since we own the van, it is not cash or bank which gives out value, it is directly the asset account called van. And we still consume something, a part of the van. This explains why we shall credit an asset account and debit a new charge account. Actually, we shall not credit directly the van account, we shall credit another account just because accounting is a process of keeping track of as much information as is useful. So the technique is this. As I said, rather than crediting directly the van account, we credit a new account called amortization BS, balance sheet, and we debit a new account called amortization IS, income statement. So we debit 620 euro, that is a new charge, in an account called amortization IS, 620 entered on the debit side, and we credit a new asset account called amortization BS with a credit of 620 euros. Let's turn to the machinery that cost 5,000 euros. Suppose it loses its value and becomes worthless in 10 years. Then every year we consume 500 euros of the value of the machinery. The formal double entry for machinery is the same as for the van. In the amortization IS account, we make an entry on debit for 500 euros. That's a consumption of the value of the machinery. And in the amortization BS, we credit 500 euros. Notice that each of these transactions are balanced. So here is our new adjusted trial balance. We had these adjustments for stocks from the previous lessons, and now we have also these two new accounts, which are adjustments for amortization. So this records a consumption of 1,120 euros worth of the van and the machinery, and this is the corresponding credit that will essentially be subtracted from the raw value or the raw value of the van and the machinery. And our new income statement now is complete. We have the adjustments for stocks that we saw before, and we have this adjustment for amortization. So this is a charge which is called a non-cash charge. We shall see that later. So the sales were 7,000 and the loss of the year is 2,120. We shall study in the next lessons other types of adjustments, provisions for possibly doubtful clients, and also prepayment and accruals. The provision for doubtful clients is simply enough that Sally owes us 500 euros. If for some reason we believe that we shall never get these 500 euros, we have to adjust for that.